President Biden pointing the finger at energy giants as the average gas in the United States has topped $5 a gallon for the first time ever. In a letter to 7 major oil corporations, Biden demanding explanations on their high refinery profit margins. For more on this, let's bring in Yahoo Finance's Rick Newman. Rick, is this a serious policy prescription or is this simply aimed at midterm voters?
Maybe it's in between, Dave. Up till now, it has seemed like Biden is complaining about the oil companies making too much money, and the oil companies are complaining about Biden bashing them. And they're all talking to a microphone, but they're not talking to each other. So now that at least there's an exchange of ideas, I guess you could call it. So Biden sent these letters to 7 big oil firms, and these are refiners. These are not necessarily they are drillers, but he's targeting refiners. And he said, you know, what's the deal? Your profit margins have tripled. They're at record levels. I know you guys have had some economic difficulties in the past. That's a reference to 2020, the COVID shutdowns, when some of these companies just lost tons of money. I mean, they lost billions and billions of dollars in 2020. And he's basically said, he kind of asked nice, could you guys please produce more oil? But this in his letter also says, my administration is prepared to use all reasonable, appropriate federal government tools and emergency authorities to increase capacity and so on. So I don't know, is that a veiled threat? Maybe. And then Exxon actually put out a response to this just a short while ago saying, look, we have been increasing refining capacity a little bit as is appropriate. And they said, by the way, if Biden really wants to do something, there are some emergency procedures he could do. And they named a couple specific ones that would make shipping easier, would make it a little bit easier to move fuels around among refineries. So they're kind of throwing ideas at each other at this point. I would not call this quite a negotiation, but at least something's happening.
I mean, we did see the American Petroleum Institute, responding, saying, look, the president really needs to prioritize unlocking U.S. energy resources. So between the back and forth, whether it's the president trying to sort of appease voters and oil refiners saying, look, this isn't on us, where does the actual solution lie for this, for the American consumer?
Here's the problem. So for Biden to do anything that would actually make a difference, he would have to backtrack on some of his green energy pledges. And that would infuriate progressives in the liberal wing of the Democratic Party. I'll give you just one example. So at least half of those 10 bullet points in the American Petroleum Institute's wish list are things that would basically undo things Biden's green energy plan. So one example is the SEC forcing all this carbon emission disclosure for any firm, not just in oil and gas, but for any firm. The API says, why don't you get rid of that rule? And that would be a powerful signal to Wall Street that you actually stand behind the oil and gas industry. You're not going to basically try to sabotage the industry once oil and gasoline prices go down. So the problem is, I just don't think Biden is going to change his climate priorities. And Biden, for his part, the problem he faces, the corner he's in, is that he's trying to get oil prices down without doing the things that would actually make a difference, because that would be a major reversal of his total energy platform.
It's a tough balancing act. It doesn't seem like he's going to win it. A big thank you, as always, to our very own Rick Newman.
Let's talk about gas prices, which are continuing to climb. The national average now breaking above $5 a gallon. That's according to AAA. Yahoo Finance's Rick Newman joins us now to share the details. Rick, obviously, this is a contributor to the macro picture that we're seeing on high inflation, the spill across every sector as a result of it. What are you seeing on that front? What's the significance of breaking $5?
Well, first of all, it freaks out drivers. I mean, gasoline prices have an outsized impact on consumer psyches just because we see the price advertised more than we see any other price. And it used to be that $4 was the price that told you something is wrong out there. And now a 5 handle makes it even worse. And this is not going to get better anytime soon. Moody's Analytics is saying that based on the current cost of wholesale gasoline, which passes through at the retail level on about a 2-week lag, they think prices could easily hit $5.50 within a couple of weeks. So this is going to be a painful driving season for people driving on vacation.
And yet, Rick, we got data from AAA last week that seems to point to demand still being there. I realize some people live in areas or actually most Americans live in areas where you have to drive to work. But I wonder how you're looking at that number. I mean, $5 is certainly sticker shock already. What's the threshold at which you think drivers maybe say, I need to reconsider the car I have, maybe the driving pattern, where I go. And this is kind of typically the busiest time of year when there is high demand for gas.
I don't think there's any single tipping point. And, we've seen this in the past. We saw this, for example, in 2008, when gas prices briefly went over $4 for the first time. I think that was higher on an inflation-adjusted basis than we have now. And suddenly you could not find a hybrid. Back then it wasn't EVs, electric vehicles, it was hybrids like the Toyota Prius, and you simply couldn't find them because they sold out. People, without a doubt, who are in that buying cycle, considering a car, absolutely respond to high gas prices and downsize their purchase plans. So I'm sure that's happening now, but everything is messed up right now. I mean, we know we're still not through the semiconductor shortage, so there is not a full supply of all the vehicles that people might want to get. By the way, consumers during the last few years have basically told automakers, we don't want your stinky little cars, we want SUVs and pickups. So they're not even making that many, and we're just not far enough along on electric vehicles yet for there to be enough of those for people to buy them. So this is going to shake out. I mean, eventually, we're still in a pent-up demand phase following the coronavirus lockdowns, and I think people seem like they're willing to suck it up this summer. But if we still have these prices going into fall, I think that will be the point at which people say, enough. I need to really curtail my driving. And of course, if it goes high enough for long enough, this could trigger a recession, though it doesn't look like that in 22.
Yeah, no short-term help for drivers at all. Yahoo Finance's Rick Newman, thanks so much.
Two economic trends coming head-to-head this summer: rising gas prices and the return to office. A recent study found that of those asked to return to the office 5 days a week, less than half have actually done so. That may due in part because of $5 a gallon gas, now the national average. So we asked you on Twitter in our poll, does the rising price of gas impact your office plans? And the overwhelming response, 76% say yes. Rising gas prices do indeed impact my desire to return to the office. Rochelle, what do you think? Is this something we're going to see actually drive down that number of people who are going back into the office even 3 days a week?
I mean, you think it has to. If every time you go to the pub, say over the last 3-4 weeks, it's another 5 cents. Now we're about to hit $5 a gallon. It's too much. People have to try and cut somewhere. So if you're still able to be productive and work from home, I mean, I certainly would choose to work from home on days like this when the gas is nearing $5 a gallon. I mean, employers have to understand that. They have to either perhaps offer some sort of perks for their workers to make it more palatable to come into the office, maybe throw in some snacks, do something to make it a little easier for people.
Well, we're already seeing employees do this. Google Map contract employees, actually last month, just around the middle of May, they signed a petition to keep working from home. Part of that reason, one was health. The other part of the reason was for high gas prices. And when you take a look at states that have even higher than the national average that we're seeing at $4.99 today, I think we're seeing more and more workers a little bit more hesitant to return to the office, especially if they are driving to and from work each day. And also, I just want to bring up Yardeni Research. They were out with figures in mid-May. Now, it's probably skyrocketed since then, but they were saying U.S. households are spending the equivalent of $5,000 a year on gasoline. That's compared to $2,800 a year ago, $3,800 as recently as March. We've seen that steady increase in the price of gas. So it's probably $6,000, maybe $6,500 in the not too distant future, Dave.
Yeah, and I think out here where we are in the Northeast, you're less inclined to hear these types of responses because most people tend to take the train. And those prices, though they have gone up, not directly related to the price of gas. But we just showed the price in California. On average, it's $6.42. One would guess that's where you are hearing a lot of workers, probably the greatest number in the country, say, yes, this is a reason I do not want to return to the office. What will employers do? Will they offer some type of incentive? Or I can't help but imagine that employers right now will see this price of gas. We're still 6 weeks away from a likely peak. Usually doesn't happen until early to mid-August, so we could be north of $5.50. By the end of the summer, maybe these employers say, let's take the rest of the summer and remain hybrid. Trivago, who we had on earlier, 4 days a month, they require people to come into the office.
And you have to keep in mind, if you're a lower income worker, it's already a lot of pressure on you already. So to factor in the fact you have to make the same commute perhaps as people earning more, but you're not getting as much back, I do think it's a tall ask. Hopefully employers do have a bit of sympathy and try and help some of their employees in that regard.
Gas prices hitting a record for the 14th day in a row, on the verge of crossing $5 a gallon. Pras Subramanian is here with more on this for us today. Pras, $4.99. Seems like tomorrow we're going to get to $5 or maybe $5.01. Certainly a massive jump that we've seen in the price of gas and really showing no signs of slowing down anytime soon.
It's been a relentless run up to $5, right? That psychologically important $5 level for gas that people are sort of, cringe at when they see. But today's data and CPI information also showed that gas is up 48% year over year, 4% last month. Even fuel oil up 17% month over month. So it's not just gas, it's like all kinds of fuel and fuel derivatives. Back to that $5 gas, the average is not there yet, but in places like New York, California, Illinois, it's already way past $5, right? It's already there. So what does that sort of mean for people? Like, are they going to drive less? And the EIA said that they saw that driving was down 2% over the last 4 weeks. So we're seeing that demand kind of come down. And then for the automakers, like back in 2009 when oil was $140 a barrel, they had to cut a lot of these big SUVs because people weren't buying them anymore. People were actually buying smaller cars, and maybe we'll see those smaller cars come back. Maybe we'll see EVs kind of come more to the fore. So, maybe there's some big changes coming to consumer behavior.
And Pras also brings into question vehicle costs, because that stuck out to me in this morning's report on inflation. They're considered the bellwether here for this inflation surge. We started to see a little bit of relief when it comes to vehicle prices, although it ticked back up by just a bit last month. Yeah.
New cars up 1% last month. Mm-hmm. Used cars up 1.8%. And that was the first time that used cars were up in 3 months. So this is like a reversal of that trend that we thought we saw some good news, those prices coming down. We have inventory still crunched. We have component shortages. You still have lockdowns here and there in places like Asia. So, what does that mean for the car buyers? And also, don't forget, we have a Fed meeting next week and potentially a rate hike. So, auto loans, those prime rates are going to go up. And we had B of A's analyst, John Murphy, on it. He said that every 100 basis point increase leads to like a $20 move in a car payment under an average $600 car payment. So that's like real money plus the gas prices. It's really kind of like, a lot of pain for consumers, especially if you drive a lot.
Well, speaking of gas prices, it's hard to miss when you see these giant numbers that are 3 foot high with these booming prices looking at around $5 a gallon. So how about some tips to help us save some money on gas? For that, let's bring in our next guest, Ted Rossman, Bankrate's senior industry analyst. So Ted, help us out. What are your top 5 tips in terms of what people can really do to try and save some money at the pump right now?
Let's start by using the right credit card. So it's probably not the one from the gas station itself. Those don't have great rewards. The interest rates are high. What I would suggest is get a card that gives, let's say, 5% cash back on gas. Something like the Sam's Club MasterCard, for example. The Chase Freedom Flex and Chase Freedom Unlimited are giving new customers 5% cash back on gas in their first year. The Costco Anywhere Visa is popular as well, 4% cash back on gas. Those warehouse club cards are great because the gas rewards are good anywhere, but they also have their own really good gas prices at their own stations. A couple other ideas would be to stack discounts. So combine that rewards credit card with grocery rewards. Chains like Kroger, Safeway, Albertsons, they can turn grocery rewards into fuel discounts. And then you combine that with the rewards credit card for added impact. One similar tip is to use the gas station's app. Their payment apps usually give you 5 or 10 cents off per gallon. Combine that with the rewards credit card.
Ted, have you seen, when you talk about higher gas prices, just people are looking to save? How is this, though, affecting how people are spending over the last couple of weeks?
I think it's very psychological more than anything else. To be honest, gas is a smaller part of the household budget in most cases than things like food and housing. But of course, those are going up too. So that's where we have this cumulative effect. And then anybody who has variable rate debt, like a credit card, well, that's going up. I think that's really what's squeezing people. So yes, you can't miss those gas station numbers, and they are in bright red letters in many cases, or numbers. So, I think that is psychological. We definitely see people cutting back on vacations. We found that about 7 in 10 vacationers are making changes because of inflation. So they're planning fewer trips, they're traveling shorter distances, picking cheaper activities. It's definitely having an impact.
And you say you can shop around, Ted. How much can you save, and how do you do it? Is there apps that we ought to be downloading?
There are some apps. Take it with a grain of salt, though. Apps like Upside and Gas Buddy, they could be helpful, but sometimes the info is outdated. I recently got tricked and I thought I found a great deal, and I got there and it was 90 cents higher per gallon than the app said. So they can't quite keep up with the price changes sometimes. I think that it is important to shop around. Just keep your eyes peeled as you drive around. Keep in mind those warehouse clubs. Again, those memberships could really pay off for gas savings and food. In some markets, you could save 50 cents, maybe even a full $1 per gallon at a place like Sam's Club or Costco. And then if you get their credit card, you could save even more on top of that.
I'm one of these people who likes to stack the discounts. I've got the app, the groceries, the right credit card. I'm stacking it all. But what about us as drivers? What can we do in terms of our actual behavior to perhaps make our gas stretch a little bit further?
There are actually some things you can do with your driving behavior. So you want to make sure that you're carrying less weight around. So if you've got a whole bunch of junk in your trunk, clean that out. Don't drive too fast. There's a real drop off, especially after 55 or 60 miles an hour. If you go a lot faster than that, you're burning a lot more gas. Also things like braking excessively, make sure your tires are properly inflated. All these maintenance tips can actually help a bit too.
Ted, when you take a look, I was looking at your notes here. Most major gas brands have payment apps that give you 5 to 10 cents off per gallon. Are there certain companies, certain gas stations that you see leading the way on this, where people, if they have the choice, they should favor, I don't know, say Gulf instead of Valero or another option out there?
I think with those apps, it's pretty universal, actually, something like 5 or 10 cents off per gallon. That I like. The gas station credit cards also give you 5 or 10 cents off per gallon, but that's very limiting because you have that card, but it's only good at that one specific station. And getting 5% cash back on, say, $5 per gallon is a way bigger discount than just a flat 5 or 10 cents. With the apps also, they're free, they're easy to download. So I think you could kind of mix and match. Whereas with the credit card, it's more of a hassle and an impact on your credit to apply. It's not great benefits. So I'm all about the apps. I don't really like the gas branded credit cards, though. Go with a general purpose option.
Ted, it may sound silly, but are we at the point where we're going up a nickel a day, a quarter a week, that it makes sense to buy a couple of gas cans and actually stock up on it in your garage or outside? Are we at that point?
You know, I don't know. Maybe it adds up a little bit. I have one for my lawnmower. I don't know if it makes that much of a difference for your car, to be honest. But it is true that these prices are going up all the time. What's really sad is you hear about some lower income people that maybe they don't have enough money right now to fill up the whole tank. So they're trying to calculate, like, what do I need to get me around next week till payday? I think that's where people really feel it.
Talk more about the auto industry specifically. Rising rates are putting affordability at risk for people who are looking at those high gas prices. They have this to contend with as well. In a recent note, our next guest said, should rates continue to rise, consumers will likely face an increase in monthly payments, of course, which could pose concerns for vehicle affordability and sales. For more on this, let's welcome in Bank of America Securities Senior Autos Analyst John Murphy, as well as Yahoo Finance's Pras Subramanian, who's here with us on set. John, thanks for being here. So you have effectively what we're seeing start to happen in the housing market, also a potential risk in the car market, right, where you are seeing financing costs go higher. But conversely, does that mean we're finally going to get a little bit more relief on the pricing front for cars?
Sure. Well, Julie, thanks so much for having me today. There's a lot of moving parts, I think, as you just alluded to, with gas prices rising as well. And I think when you look every 100 basis point increase in auto loan rates, it's about $15 to $20 on a basis of about $600 on monthly payments. So what we've seen is about that so far in a 48-month average rate. Auto loan rates have not been as volatile as mortgage rates. So we're getting sort of an impact that is not as big. But as you look at this versus gas prices and depreciation costs, you're kind of at a push on the monthly carrying costs to the consumer when you include depreciation costs. Now that means you're selling your vehicle and you're getting the benefit of lower depreciation. So there's a lot of moving parts here. But all else equal, these rising rates and these rising gas prices are a real problem for auto demand. The caveat really to all of this is there just aren't enough vehicles on dealer lots and 1 to 3 year vehicles on the road in the United States. So we are building a lot of pent up demand, and the consumers that are buying nearly new used vehicles and new vehicles as well are fairly well-heeled, higher income consumers that will be less impacted from this. So where we're starting right now at recession level auto volumes, because supply is so constrained, we don't have a lot of concern about too much downside to demand, but it could really dent any significant recovery in the next 1 to 2 years.
Hey, John, Pras here. You guys had a lot of good information in your note about, the level at which, we've seen situations where high rates haven't actually led to decreased sales in autos. But is there a point where there is a rate that would actually destroy kind of demand for new cars or even used cars at those where rates as they are now?
Sure. It's a really great question. So if we look at, the 100 basis point rise in rates, it's about $15 to $20 a month on the monthly payment. If we've seen what's going on with gas prices, it's about each dollar increases, or actually the $2 increase is almost about $40 to $60 a month on each individual vehicle. But then when you look at depreciation cost being lower because used vehicle pricing is higher, you have about $100 good guy. So the net of these three big moving parts of rates, gas prices, and depreciation costs are not too tough for that new vehicle buyer. Once you get to sort of the second and third buyer, that's where things get, into sort of the middle and lower income consumer, and things get tough. So I think we're looking at sort of the balance of these three big swing factors right now, and the strength in used vehicle pricing is a very important and actually bigger factor, believe it or not, than what's going on with rates and gas prices. As we increase the supply of vehicles that are being produced, there's risk that depreciation will go up, cost, and we could see things really keep a lid on what we expect to be a significant recovery. So we got to watch all three of these factors, swing factors, moving at the same time. So the interest rates are actually less important, believe it or not, at the moment than gas prices and that depreciation cost.
John, we've seen a massive push by the major automakers into crossovers and trucks, but that has come against the backdrop of relatively affordable gas prices. That's no longer the case. Do you think we'll see them swing back to making passenger cars because of this environment we're in?
Well, there's a lot of different strategies in the market right now where the D3 or the traditional D3 have moved away from passenger cars, and the Japanese and Koreans have still kept a reasonably large portfolio there. So that's where the benefit would come, more on the Japanese and Korean side, if we see this kind of a move. Because we're selling so low in sort of the sales rate recession levels because we're supply constrained, the mix is going to stay very strong until we actually see supply coming back up and actually get a sort of a vehicles available for sale, right? Because they're just not there at the moment. So I do think in the recovery, you could probably look at sort of a greater mix of passenger cars and smaller crossovers. Remember, these crossovers are unibody, essentially jacked up station wagons, if you will. They're not the body on frame gas guzzlers. They're relatively fuel efficient themselves. But you'll still see a negative mix shift as we go through the recovery. So that would benefit the Japanese and Korean companies a bit more than the D3. So that would dent industry profitability relative to the recovery in volume. So once again, we'll have to watch operating leverage versus mix, and that'll be a delicate or interesting dance when we look at profitability through the value chain.
Hey, John, on a related note, when you look at the affordably priced hybrid and electric vehicles that are out there, I mean, it doesn't seem like there would be enough to meet demand if there is indeed increased demand with higher gasoline prices, right?
Yeah, there's another, it's a very good question, Julie. There's another very difficult dance here right now with that. And when you look at the increase in nickel, cobalt, lithium prices, the cost of these electric vehicles has gone up much more dramatically than even the internal combustion engine vehicles. So unless the industry wants to eat, an incremental $1,000 of cost on an EV versus an ICE, they're not going to push the EVs as aggressively here in the near term. And if they do try to pass that cost on to the consumer then has to eat another $1,000 plus for the payment or the price of these EVs. So that switch, which if you were just to look at gas versus electricity cost, makes all the sense in the world. But when you look at the asset price coming in, it becomes a lot less clear and actually becomes a net negative for EVs versus ICE on affordability in the near term. So like I said, there's a lot of moving parts of what's going on here right now. But that raw mat swing on EV costs has been pretty extreme in the last 6 months, even more extreme than what we've seen in gas prices or steel costs going into the cost of ownership on an ICE vehicle.
Hey, John, given all those moving parts and the rising rates and things like of that nature, as well as the kind of diminished supply, in your coverage universe, what auto companies or what suppliers are really well positioned here to do well going forward in the next year or two?
When we look at, we cover the value chain, so we cover the automakers, suppliers, and dealers. And what's happened in the course of the last 2 years is the automakers and dealers have benefited tremendously from the improvement of mix and price. So they've been able to more than offset the volume pressure. So it's been pretty impressive, and as well as very good execution. The suppliers have not benefited from any real pricing power because their end consumer is the automakers. They're not really changing pricing on a real-time basis. So they've been really getting hit in a way that the dealers and the automakers have not by just the pure volume decline. They're just eating it pretty hard on this volume decline. So I think as we look forward on a relative basis, the suppliers are likely to do a lot better if the semiconductor chip shortage issue works out and other supply chain constraints get worked out and we see a real volume lift. I think the automakers and dealers will also do fairly well, but on relative to expectations and where people are thinking about how they're thinking about these stocks and the different links in the value chain, the suppliers are the most depressed and have been hit the hardest fundamentally because they haven't had the benefit of pricing power at the consumer level.
John, at this point in time, is it more beneficial for a potential buyer, prospective buyer, to get a used car or a new car? That's all they're thinking about right now.
That we got a lot of moving parts here. When you look at this, the relative price of a 3.5-year-old vehicle, and some of these stats are coming from our great friends at Manheim and other used car sources, you basically are looking at 10 to 15 points above normal on a used vehicle price relative to a new. So normal of a 3.5-year-old vehicle would be around 50 to 55% used vehicle price to new vehicle price. Right now, it's in the high 60s, close to 70%. So relative to history, the value buy was always to go to the used vehicle. Right now, if you have a vehicle to trade in, you may actually be better off buying a new vehicle if you can actually find it, right? That's the big catch. The vehicles are really not that plentiful. So if you are lucky enough to own a used vehicle that's inflated in price, as opposed to buying another used vehicle, you're probably better off stepping into buying a new vehicle at the moment.
Welcome back. Another record for gas prices, with the national average hitting $4.85 a gallon. Our next guest says we haven't seen anything yet. So let's brace ourselves as we bring in our guest, Stephen Schork, the Schork Group principal. Stephen, thank you for joining us. So obviously a little bit nerve-wracking here. So then what are the expectations then in terms of what we can expect for the summer?
Yeah, absolutely. We're just now getting into the peak demand season, and it's already gotten off to a very strong start. With crude oil prices hovering right around $120 a barrel right now, should these prices remain, and I suspect they will through the end of the month, that does translate now into a national average of well over $5 a gallon. In fact, $120, $125 correlates to a national average of $5.40 at the pump as we head off to our 4th of July picnics.
On Sunday, it was interesting. Pete Buttigieg, the transportation secretary, is on ABC, pressed about gas prices. He said the Strategic Petroleum Reserve release did actually stabilize prices. And then he was pressed on if the president, any president, really has an impact on the price at the pump. Here's what he said.
But we also know that the price of gasoline is not set by a dial in the Oval Office. And when an oil company is deciding hour by hour how much to charge you for a gallon of gas, they're not calling the administration to ask what they should do. They're doing it based on their goal of maximizing their profits.
Stephen, one, did the strategic release have any impact on the market? And two, does any president truly impact the price of gas?
Well, I don't know what color the sky in the world of the Buttigieg's world is, but in the real world, absolutely. The SPR had an effect on prices. When we released the barrels, the first batch in November, oil prices were $70 a barrel. Today, they're $120 a barrel. It was an absolute sign of desperation that this administration has no plan. Yes, I'm sorry, energy policy matters. The White House's rhetoric matters. Capital goes where it is welcome, stays where it is well treated. This administration has made it very clear, even before they won election, that they are going to be, and they fulfilled this, the most hostile White House towards the oil and gas industry. Therefore, we're looking at an industry that underinvested in fossil fuels during COVID as prices crashed, as big oil lost $66 billion in 2020. That investment has not come back. In fact, we've seen policy, we've seen the shift in both Wall Street and in the White House to move barrels, to move investment towards decarbonization away from fossil fuels. So quite frankly, the money's not going in, and this is policy set by this administration. And then when you set the signals that we are trying to release barrels from the SPR, we clearly don't know what we're doing here. The Secretary of Energy doesn't even know how much oil the United States consumes on a daily basis. When she was asked in November what her plan was to increase U.S. crude oil production, she laughed at the interviewer. So now we have a situation where we are waiving the ethanol requirements, and we're going to allow more ethanol to go into the gasoline blend. Guys, this sets the stage for even higher higher food costs, because right now the corn industry, their production, 40% of it goes into ethanol. Now we're increasing the demand for ethanol of corn, which is going to now be greater than 40%. Because fertilizer prices have doubled over the last year, thanks to the war on natural gas. We're planting less corn going into the ground today. So when we take this corn out of the ground in the fall, we're not going to have the same amount quantity as we did a year ago. And we've artificially increased the demand for corn from the energy industry. So therefore, we're looking at runaway inflation that's going to last through this summer, going into the fall, not only for energy, but also for food costs.
Well, Stephen, you say runaway inflation. I guess two-part question here. One, how bad could it potentially get? And then for possible solutions that could be on the table, we know Congress is considering possibly pausing the gas tax. Is this something that the Biden administration should act on right now?
Yeah, it's a big deal. You're taking 18 cents of the federal tax. You've got a national average that's going to go to $5.40. Do you really think taking 18 cents? I know I'm not attacking you, but this administration, do you really think taking 18 cents and taking oil prices from gasoline prices from $5.40 to $5.20 is really going to make a difference? Hey, if you really want to try and make a difference, how about we waive the Jones Act? That is to say, we waive the requirement that all interstate commerce, waterborne, on a barge, on a vessel, has to be on an American flag vessel. Why don't we waive that action, allow foreign flag vessels to carry gasoline that's being manufactured in the Gulf of Mexico in the Houston refinery epicenter, put those on American flag vessels, foreign flag vessels, and allow that gasoline to be rerouted over into the East Coast. So pulling back and playing games with the taxes, no, it's a silly move. It does not address the long-term structural imbalance in this market. We have a balance where refinery capacity here on the East Coast, which is what drives the NYMEX futures price, refinery capacity has been slashed over the last 10 years by 55%. So quite frankly, we don't have the refinery capacity here on the East Coast to make gasoline, hence why we are looking at very low supplies. And now we have a Commerce Act that does not allow or limits the amount of gasoline to be shipped from Houston into the East Coast. So we are barking up all the wrong trees, playing gimmicks with tax schemes where we could be absolutely passing legislation or waivering the ability for the market to easily transport gasoline from where it's being manufactured to where it's being consumed.
I want to bring in OPEC and OPEC Plus. Obviously, they agreed to increase production, but they're also dealing with some of these sanctions on Russia. What sort of impact do you think they can have, and what sort of economic impact do you think these sustained high oil and gas prices will have on the economy?
Yeah, the OPEC, there or any oil producer, it's a very fine line, because you drive oil prices high enough, you sow the seeds for recession. And if we are not in recession now, we are going to be in recession by the end of the year. That is, virtually a fact. Every single recession, starting with the Arab oil embargo in '74 up through the Great Recession, every single recession has been preceded by a precipitous rise in both energy and food costs. The current spikes we're seeing in those two commodities, we've never experienced before. So recession at this point is unavoidable. So now if you're OPEC, if you are Texas, if you are Russia, what do? Do you increase production now where the likelihood of a severe economic downturn is clearly right around the corner? So the answer is you're going to hold your cards tight. You're going to make incremental increases to production to get supply to the market. Under the understanding that probably within 6 to 12 months, you're going to see a significant pullback in demand because the United States and thereby the globe will be in recession.
Americans from coast to coast are feeling the pinch, a new record high when it comes to the price of gas. Yahoo Finance's Danny Romero has more on this. Danny, good to see you here.
Yeah, same to you, Jared. Gas prices are skyrocketing nationwide. A gallon of gas, of regular gas, is now hitting a record high of $4.67, which is 16 cents higher from a week ago and 34 cents up from last year. Now, many experts believe that when gas prices hit that $5 mark, that really it'll become a pressure point for a lot of drivers who could really curtail some of their driving plans this summer. 8 states so far are over that $5 mark. In California, gas prices are above $6.24, and in some areas it's even $7. So just take a listen to how some of these drivers in California are really handling and trying to, maneuver these high gas prices. Take a listen.
I have been tipping Uber drivers more and delivery guys more. One guy delivered landscaping plants for me, and I tipped him $80 because gas was so bad, and he drove a big box truck. So I try to be mindful of other people that do have to drive a lot because it can completely change. If you add up drivers that it costs $100 to $200 a day, that really cuts into their livelihood for sure.
Over time, it's going to start taking a toll because our minimum wage isn't meeting what the prices are for gas or whatever. So a day of work is say you work minimum wage somewhere, you work 6-hour shifts, maybe part-time, or if you work full-time 8 hours and you're making minimum wage, what you make in one day is what you're going to end up spending for gas to fill up your tank.
And you can hear it right there that pay is really not keeping up to pace with these high prices. Still, drivers are still driving. We saw during Memorial Day that there really was high traffic as well as demand, which is one of those factors pushing up these prices, along with the war in Ukraine, as well as the partial embargo on Russian oil, and also the reopening of China. But these gas prices and sky-high inflation are posing a real economic threat to consumers. Jared?
Danny, a very serious topic. I noticed that you were able to speak with Andy Garcia and John Hamm, both California drivers. Were you able to reach out to Arnold Schwarzenegger or anybody else with a famous name?
No, not. I didn't get that far.
All right, we're
Jared.
going to have to appreciate you stopping by as always, and we're going to have to leave it there. Yahoo Finance's Danny Romero.
Stat of the day, millions of Americans hit the road Memorial Day weekend, and record high gas prices might have burned holes in some digital wallets. The national average price per gallon of regular gas was 12% above the highest level seen in 2022 over the holiday weekend, says the folks at AAA. Prices rose about 11% just in the past month alone, and most recently, gas was above $4 a gallon in all 50 states.
Pain at the pump has some travelers rethinking summer vacation plans with gas prices soaring, hovering at an all-time high heading into the holiday weekend. There's a new survey out that shows high pump prices are a bigger factor for traveling this year than COVID. 90% taking gas prices into consideration when deciding if and where to travel this summer. Let's talk about this with Chip Rogers. He's the president and CEO of American Hotel and Lodging Association. Chip, it's great to see you again digging into the survey that you just put out. 25% of Americans here are likely to travel this weekend, a third for July 4th, 27% for Labor Day. If we don't see any relief at the pump, what do you think those numbers are going to look like?
Well, best case scenario, they still travel, but they travel a little bit closer to home so that they can stay in a hotel either way. But our big fear is that both inflation starts crowding out that spending that you normally would do on travel or you intend to do on travel, and then gas prices just become so high you can't afford to do so. So those are our concerns. but the demand is certainly there. We are seeing a leisure travel demand boom. Business travel not back yet. Meetings and conferences not back fully yet, but the demand for leisure travel is significant.
So, Chair Rochelle here, I want to ask you about the sort of the domino effect. When you do have the high inflation and the gas prices, how does that then affect things like demand for hotels and the sort of staffing and the other things that come with this perhaps demand destruction?
Yeah, I mean, it's problematic. First and foremost, we have never seen gas prices like this before. So historically, when we look back, gas prices themselves don't dictate the number of people who travel. It may change the pattern in which they travel. And we are hoping that that's the case this time. But we've reached historic highs. I mean, looking at gas prices more than 50% above the same time last year. And if they continue to rise throughout the summer, that will cause some people to make the decision not to travel, which is the last thing we need coming off 2 terribly bad years where hotels were devastated.
So, Chip, you talked to the big hotel chains, you talked to smaller mom and pop shop type of hotels. What is the overall sentiment out there right now, given the fact that we are facing high inflation? Are they still pretty positive over the next couple of months?
Yeah, I think so. Everyone's still very positive. I mean, look, we're coming off of 2020 was the worst year in history for the hotel industry. And 2021 was one of the worst years. And so pretty much anything looks better right now. There still is some optimism out there, but growing concern over these gas prices that continue to go up and up and up and the impact it might have on travelers. Again, right now, we're living off of almost exclusively leisure travelers. The business travelers are not back yet because people aren't fully back in the offices. And the meetings and conferences, it's going to take a couple of years to fully get back to where they were in 2019.
And obviously with COVID, a lot of international travel was having issues in terms of people being able to come from country to country, different rules. What are you seeing in terms of overseas travelers coming to the US and wanting to travel and spend here as well?
Well, they want to, but the U.S., we don't necessarily make it that easy. We're still the last country on earth for people to get back into the country without taking a test, or I should the last developed country. And so we don't even make it easy on our own citizens who go across the pond and decide to come back to here. But where you're seeing it manifest itself are really in those gateway markets. If you look back the last 2 years, the 3 worst cities almost every single week have been New York, San Francisco, and Washington, D.C. And just last week, again, San Francisco, the worst in the country compared to 2019, and that's because the Asia travelers can't get in. Flip side of that is places that have been open the entire time, especially in Florida, Miami, Tampa, and then Phoenix and Arizona. Those have been the 3 best markets. And so domestic travel booming, international travel still hitting key markets in a bad way.
Chip, a big roadblock here, a big challenge for the industry, as in a number of industries, is just simply finding the workers. We've had this massive labor shortage, obviously having a huge impact on hotels and really the travel industry at large. What are you hearing from the hotel owners? Are they able to find the workers that they need?
Boy, this is the biggest challenge we've had in quite some time. Had a large group of owners and management companies in my office recently. I asked them what the 3 biggest challenges were. First gentleman that spoke up said 3 biggest challenges: labor, labor, labor. And all of them agreed. The problem that we're facing right now is at a time where hotels need to recoup all those massive losses over the last 2 years, they're actually having to shut down rooms because there are not enough employees. So think about a situation, you're a small business owner, a hotelier, you have the demand to maybe even sell out your hotel over a weekend, but you have to shut down a portion of the rooms because you don't have enough people. That's a terrible position to be in. We're working through this. Everybody needs more workers, but our industry especially.
And how are you finding that some of these smaller hotel companies are able to adapt versus some of the large ones who perhaps have a bigger budget to work with and really sort of manage to be able to do things like close down rooms?
Yeah, well, they're relying a lot more on technology. Being able to determine when people are showing up and when they're leaving certainly helps you determine when a room needs to be cleaned, and that's going to help you manage your staff better. Second part of that, most of the food and beverage outlets in hotels have shut down. You're not going to see as much room service anymore. People are comfortable using food delivery apps, and right now for hotels, that's fine because we don't have the personnel to service those guests food and beverage at this moment anyway. And so they're really trying everything. But the reality is, if you go to a hotel right now, the experience is going to be very similar to what you saw prior to the pandemic. So hotels are doing everything they can to focus on that guest experience, but recognizing they may not be able to sell out 100% of the rooms at this time.
Chip, what about the business traveler? Because we certainly have seen the business traveler come back a bit. It's still not at levels that we saw in 2019. Will we ever get back to those pre-pandemic levels, do you think?
So good news and bad news on that front. You're absolutely correct. I'm sitting right here in Washington, D.C. in an office park I might be the only person in this entire building right now because it's a Friday. And that's the trend we're beginning to see. Now, the flip side of that is even though most people aren't back in the office 5 days a week, what's happening with many business travelers, and we surveyed this, 90% of business travelers say that they're adding extra time on for leisure travel. We call that bleisure. So they may be going somewhere for a 2-day trip that they now turn into a 3-day trip. And the reason is because they know they can work remotely from their room and yet still avail themselves to the leisure activities of that location where they've traveled to. And so good side is this leisure travel concept is beginning to expand. The bad part of it is that because of remote work, people just aren't in the offices 5 days a week.
Indeed. Well, I hope you do have a pleasant holiday weekend there. Thank you for joining us. Chip Rogers, the American Hotel and Lodging Association President and CEO.
Surging gas prices could disrupt summer travel plans for millions of Americans as prices soar at the pump. Now, the national average hovering near an all-time high, inching closer to $5 a gallon. Right now, it's at $4.59. For more on this, we want to bring in Patrick Dehaan, $4.60 it looks like today. Patrick Dehaan, Gas Buddy's head of petroleum analysis. Patrick, I think the big question every single American is asking right now is how much worse could this potentially get? We heard from J.P. Morgan. They're saying it could be over $6 by August. What are you seeing?
Well, nothing's really off the table. I think $6.20 a gallon is probably not going to happen, but it's not impossible either. We have a very unique setup this summer, very tight oil supply as a result of Russia's war in Ukraine and sanctions on Russian oil. In addition, we're talking about a nation that has seen 1 million barrel a day capacity at refineries gone from where we were 3 years ago. So less ability to refine as much product, and a very insatiable appetite for Americans to hit the road this summer. 58% of respondents to our Gas Buddy summer travel survey said they'll be hitting the road, even in light of record high prices, which amazingly is a higher percentage than what we saw last year.
That is incredible how it's not impacting demand, Patrick. But let's look ahead to the summer months. Do we have any studies that show as prices climb, how demand may fall with it?
Well, we are seeing demand that certainly is not as strong as it was prior to COVID in 2019 when prices were much lower. I don't think that's going to change. We are not in for a record-setting summer when it comes to gasoline consumption, but we are at a record-setting summer for prices, and it's partially because of that reduced refining capability that prices will likely remain elevated in light of demand that's relatively weak compared to the last few years.
Hey, Patrick, I'm curious to get your thoughts on the Biden administration and what we've heard from President Biden when it comes to lowering gas prices. Now there's reports that Biden hasn't ruled out using export restrictions to ease soaring prices. How big of an impact do you think this could potentially have?
Well, it's all in the details. Obviously, U.S. oil companies would be very sensitive to export limitations. Keep in mind, a lot of U.S. oil companies export oil that they can't utilize at their refineries and import oil that they can utilize. And so to put a bottleneck in place that doesn't allow the free flow of oil may, number one, hurt refineries' ability to refine oil, but it may disincentivize oil producers and refiners from producing as much product as they otherwise would. So the administration has to walk this very carefully. I understand the temptation. The U.S. exported over 10 million barrels a day of refined product just in the last week, or 70 million barrels total. But this is something that is very nuanced.
Of course, the price at the pump we feel every time we fill up, Patrick, but diesel prices we necessarily don't, although we feel it when we pay more for food and groceries and clothing because it's really a part of everything that we buy. The ARS oil at a record high, $5.54. I know the Biden administration has talked about tapping emergency supplies, talked about loosening environmental rules. How much impact do the diesel sales have on the economy, and how high do you go? Because one JP Morgan analyst said $6.20 by August.
Well, I'm hopeful we won't get there for gasoline. Now, if all the stars are aligned, it's possible. I still think it's very improbable that gas prices would climb another $1.60. But on your point about diesel, I mean, we've seen how it's implicating or causing harm at the retail level. Walmart and Target citing challenges with logistics, and the high price of diesel and fuel is hurting their bottom line. And this isn't going to disappear. And part of the story here is what I had mentioned, that drop in refining capacity The same time, Europe has also seen a drop in refining capacity at a time of economic rebound. So this is a situation that the president really doesn't have the capability to build a refinery overnight or to increase oil production overnight, right? All of these supply challenges are hurting things. Having said that, if the president does make moves, it would likely take years for that to help alleviate high prices at the pump. So this is something we'll be stuck with, I'm afraid, most of the summer.
Patrick, when you take a look at the rig count, and I was looking at a recent tweet that you just put out, you're saying that U.S. rig count has been rallying last week, touching those pre-pandemic levels. How meaningful is this?
Well, it's a leading indicator of what may happen in the months ahead. It's certainly not a guarantee, right? It just shows that oil companies are increasing activity, increasing interest in drilling for more oil and potentially bringing that oil to market. But the total rig count, including oil and gas rigs, is now 234 higher than it was a year ago. So these are the signs that the industry is moving, right? The locomotive is picking up steam. But unfortunately, as we are finding out, it takes years to get the increase in drilling activity to translate into more U.S. oil production.
So is the only hope right now an end of the war in Ukraine?
Well, and even that is fraught with questions, such as, do we go back to investing and doing business with Russia and how quickly? So even an end to the Russian invasion of Ukraine doesn't necessarily rubber stamp price relief here in the U.S. I think the best outcome that would bring most meaningful relief is out of our control, right? It may be in the Russian hands, and that's regime change may give confidence that Western companies and countries rather can start doing business and buying that Russian oil again.
And that is such a huge question moving forward. Will we return to doing business with Russia after the invasion is over? Patrick Dehaan, Gas Buddy, head of petroleum analysis. Appreciate you joining us. Thank you, sir.